Welcome, everyone. Happy Wednesday. My name is Josh Campbell. I'm the CEO of Clara Media. Thanks for joining us for another Worth Live virtual event. I guess we've been doing these now for about 14 months. It's amazing to think we weren't doing them before the pandemic. So glad everyone was able to join us. Today's topic, SPACs, the SPAC phenomenon. I was telling someone earlier that I was at a dinner party about a year ago right before the pandemic, and someone brought up SPACs, and I had zero clue what the word was. Had to go home, do my research, and fast forward a year. It's amazing. You probably don't leave a conversation without it coming up. So really excited to sort of bring everyone into the dialogue. Before we get to the panelists, if you do have questions, if you do want to engage throughout the conversation, please try to use the Q&A function, and we'll get to everyone's questions if we can. You could also send information or comments via chat, and Emily, who'll be moderating, will try to get to those. So really appreciate the support of UBS for helping bring this conversation to you. We'll be sharing the link with the content following this event. So please, if you have colleagues, customers, partners who weren't able to attend, to please share the content with them. Without further ado, I'll hand it over to Emily Cegielski, our editorial director at Worth, to moderate the conversation.
Welcome, everyone. As Josh just mentioned, I'm Emily Cegielski, the editorial director here at Worth, and I'm thrilled you could join us for this session on the SPAC phenomenon. SPACs, or special purpose acquisition companies, took Wall Street by storm this past winter, raising over $150 billion this year. But with SPAC shares currently in retreat, many blank check firms are now trading below their debut price. The pressure to execute deals at realistic trading valuations could get even more intense in the months ahead, because nearly 260 blank check companies with about $87 billion on hand face merger deadlines in the first 3 months of 2023, according to an analysis of SPAC research figures. So what's behind the SPAC phenomenon and what's to come next? This afternoon, I'm thrilled to be joined by some incredible experts in this field. Carlos Alvarez, Managing Director and Head of Permanent Capital Solutions at UBS, Jim McCann, Chairman of Worth and Chairman and Founder of 1-800-Flowers, and Sharon Sager, Managing Director and Private Wealth Advisor at UBS. It's so great to have you all here. Thank you guys for joining us.
Thank you, Emily.
Thank you.
First, I'd love to just kind of have a quick personal check-in. How are you all doing? It's been a long year and a few months, but it's great to see you guys' faces, and hopefully we'll be able to do this in person soon. Carlos, I'd love to start with you. How are you doing?
I'm doing great, Emily. As you can see, still kind of working from home. It's amazing. It's been already 15 plus months, and I guess we're starting to see a bit of a path back to normalcy, although I'm sure it won't be easy or straightforward by any means. But look, obviously we're all coping with it as best we can and trying to make the most of it. And so look, happy and fortunate that everyone in the family is healthy and no issues. And so I'm importantly glad to be part of this panel. Looking forward to the conversation very much.
Sharon, how have you been?
I have been great. I am happy to be back in New York from hiding out in Florida, and reconnecting with friends and family, actually meeting some new family members that were born during the pandemic. It's a joyful time.
Jim, how are you?
Similar. Everything's going well. Everyone's safe and healthy nearby. Things are getting a little bit more normal every day. And Sharon and I live near one another in the summertime. And a big overhang question for me was, for the last 14 months, my grandkids have been told to steer clear of us. They can endanger us. And I wondered what the long-term impact would be on them of this separation. And my kids have all appropriately been very, very careful. But I'm happy to report on a rainy Memorial Day weekend on Long Island, we got to interact with the grandkids, and they seem to have forgotten distance, and they want to jump on your back, and they want to entangle around your leg and hug, and is a wonderful weekend.
And Jim, I'll just add to that in terms of the young people, the way our parents and grandparents used to talk about the Depression and the wars. I think these younger people will be telling their offspring about this pandemic, which was essentially a kind of war.
And isn't it a miracle that we're starting to talk about it as if it'll be in the rearview mirror fairly soon? It's an amazing scientific accomplishment.
Yeah, it's crazy how much has changed in the past year. And something that really has emerged during this pandemic is this explosion of SPACs. Obviously, they're not.
Did you see how clever she brought that back around? She's like an editor or something.
Thank you, Jim. Thank you. I'll take the compliment. But yeah, no, SPACs really have exploded this past year. They've been around for longer, but we've really seen them grow during the pandemic. And I'd love to hear a little bit about how you guys, all of you, are involved with SPACs. Jim, I know you come at this from a different angle than everyone else on the call. So, Jim, tell us about your foray into SPACs.
Sure, it's a relatively new involvement for us, and the us here is 5 years ago I stepped down as CEO of Flowers and became the chair. My younger brother Chris became the CEO, and one of the motivations there was to involve our family in investing, and so we created an investment platform, a family office with an investment capability. Because we, in the flowers business, we learned a lot about new technologies fairly early on. So we wanted to, beyond using those technologies to make us a better florist all the time, we wanted to invest in technologies we thought had special promise. So we started that about 5 years ago. And in that time, we did continue to become an active LP in, let's call it a dozen and a half venture or private equity funds. We made some direct investments and some acquisitions. And along the way, particularly over the last 12 to 20 months, a couple of times we got involved in those as an LP in some of those portfolio companies. When we were providing advice, we thought a SPAC that we had come to learn a lot about, Emily, would be a really elegant solution for capital needs of the companies we were invested in or advising, or both. And that happened 2, 3, 4 times last year. And then finally, Paul Stimulus, who runs Clarum, our family office, said, I think we should be in the SPAC business too, because it's so frequent now that we're advising other people to consider it. If a company would benefit from our expertise, hard earned and won over these 40 plus years in the business that we're in, perhaps a combination of capital and some value add in terms of expertise and resources would be a good solution for other companies. So we decided to launch our own SPAC, which we did in February of this year. And so we're in the marketplace looking for companies that not only need and could benefit from capital, but would benefit from this team of about 22 people that we've assembled that have real expertise in developing relationships with consumers, whether or not it's your primary access channel, looking for companies that want to have an omni-channel kind of presence and want to be able to tell their story and really develop it in a deep and long relationship with their targeted consumers. And it's been an interesting run of it. My business education is getting turbocharged as a result of this process. We're seeing lots of really interesting and exciting companies. And Carlos, this is your area of expertise, but it seems that in spite of the fits and starts that we're seeing in the SPAC marketplace, that pendulum always seems to swing a little too far each direction. It seems to me, my guess, Carlos, is that this will become the third leg of the stool in terms of how a company might consider accessing the public marketplace, whether it's a traditional IPO, a direct listing, which we've seen several successful direct listings in the last 6 to 12 months. And now a legitimate SPAC market is another good alternative, and different size for different circumstance.
That's so exciting. Carlos, tell us, I'd love to get a little bit more about your background and also like what do you do day to day with SPACs? How, like, I know you're the expert, so I'd love to kind of hear a bit more about your background and really what that looks like for you.
Thank you, Emily. So yeah, I'm I'm the head of a team at UBS that we call the Permanent Capital Solutions team. So it's a group within our equity capital markets division in the investment bank that really helps with all aspects of capital raising and advisory for SPACs. So effectively, it's a SPAC dedicated unit that we have within the investment bank at UBS. It is only one of the ways in which we interact with SPACs at UBS. Obviously, Sharon very shortly will also share perspectives from her side of the business and the investor point of view, et cetera, right? But where I fit is, again, on the investment banking side. I've been in the business overall over 23 years, and the last 17 of those really around SPACs. I've been involved with this market since 2004, which really was the time where the big banks started to get involved with the structure, which, as you said, had been around since the early 90s, right? So SPACs are definitely not a new phenomenon, but one could argue that they've clearly taken a very meaningful step function over the last 15 months or so, which is extremely exciting. And so again, we have a team that just really gets involved with the structuring and the IPOs on the front end when teams such as Jim's are looking to raise capital from the market. And then subsequent to the IPO, we are also very active in helping teams assess potential business combination transactions. Oftentimes, these transactions are coming to market with an incremental financing component through an incremental equity raise, or in some cases, debt financing. So we help with those aspects as well. And so, yeah, it's been kind of a fun time to be in the business. Clearly, very, very active market, which has given all of us plenty of opportunity to learn even more about this market, and happy to share some of those perspectives as we get into the conversation.
Yeah, very excited to hear more of your thoughts on this, Carlos. Sharon, I'd love to hear, like, why are your high net worth and ultra high net worth clients interested in SPACs? Like, what are you hearing on the client side?
Yeah, thank you, Emily, and thank you, Jim and Carlos. As private wealth advisors, we advise families and individuals of substantial wealth on all aspects of financial life. So that can be from as basic as a strategic wealth assessment through legacy and succession planning. So obviously an important part of that is investing. And for our client base, ultra high net worth individuals find SPACs appealing because of the redemption feature, the ability to redeem at the 2-year or so mark. They can have sort of a no risk free look at a growth company, knowing their downside is limited by that redemption feature. And in some cases, they might hold the warrant for upside. But our clients look at SPACs as a liquid private equity alternative, sometimes a cash management alternative, and it gives them access to the new issue market through SPACs. But then some of our clients, many of our clients, I should say, are run private operating companies. So they're entrepreneurs, founders, wealth creators. And I mentioned succession and legacy planning. A SPAC can be an opportunity for succession or generational wealth transfer without a public IPO. And it's also a non-private equity alternative. Say some 70-year-old executive who's been running a family business or a private operating company might not want to work for a 30-year-old private equity executive, and then also have the pressure of the fund wanting to bring it to a liquidity option. So it's patient capital. Some of our clients look at it as participating in SPACs or selling to a SPAC as another shot to be a public CEO or chairman. And finally, many of our clients are have been approached or are SPAC board members, some SPAC sponsors, because of their operational expertise, deep industry knowledge, or high name recognition and well-respected reputations. So we really are involved from all sides.
That's incredible. I am excited to hear more of your perspective as well. I'd love to just kind of jump right in. Carlos, what happened this past year? Why have SPACs just taken off? What is the genesis of this all?
I think it's a great place to start, Emily. And I think it's been a bit of a combination of factors, right? So I think that the SPACs have been, again, around for quite a while. But I think what happened over the last few years is that increasingly higher quality sponsor teams, the likes of Jim and his team, started to really pay a bit closer attention to this and what it could be. At the same time, we have effectively a real need in the marketplace where there are a lot of companies that are looking to go public, but they could really benefit from a degree of sponsorship and somebody who has the right experience that can be brought to bear in addition to capital to really help go through that transformational process to take a company public. And then the final ingredient, I think, was actually the onset of the pandemic, when a lot of the other ways that Jim referenced that companies could go public, whether the traditional IPO or the direct listing, actually became quite disrupted. The IPO market closed effectively for a period of time. And that exposed some of the risks in those more established alternatives to take a business public. And I think that in turn highlighted perhaps a bit more of the benefit of the SPACs. And so I think the combination of all those trends, I think, have led to many and actually better companies now considering the SPAC as the preferred way to go public. And again, I think if I would single one reason, to me, clearly is the increased quality of sponsors that are now really driving this market. And then again, Jim said it perfectly. It is that ability to bring something beyond capital. The capital is a commodity, right? But if a company can benefit from a team's real experience and ability to add value over time, why not? It is also a process that I think meaningfully reduces the execution risk from a company's point of view. And as CEOs and leaders and their boards think about the pros and cons of one path versus another, the SPAC, I think, compares quite favorably in a lot of cases. So a combination of all those things really saw the market effectively catch fire last year, right? This was a market that during 2017, 18, 19 was seeing roughly $10-ish billion per year of IPO volume. And that jumped to roughly 82 billion in 2020, most of that post-pandemic. And then even this year, the first quarter alone, I think by now we're already well over 100 billion in 2021 year to date, with still 7 months to go, right? So I agree completely with Jim that I think SPACs are becoming well established, right? The market always kind of goes through, he also said, the swinging of the pendulum. I completely agree with that. And, things have been a little more volatile and challenging as of late, but I think that is a natural consequence of the market just digesting the huge amount of volume that it absorbed in the first part of this year and late last year. So really interesting, the SPACs becoming now a much more institutional, professionalized market, which I think speaks to the staying power, hopefully, of the structure going forward.
Jim, I think you're on mute.
Would you expect this year that there'll be some carnage, that some of the SPACs that don't really have the right expertise or value add will not find deals, and will that be part of the pendulum swinging?
I think so, Jim, and I think that is to be reasonably expected, right? In a market that has seen such an uptick in the number of sponsor teams that are involved. And yes, I would say that as well, the other side of the market, and you obviously you see this, you are in the front row seat of seeing this. I think now the universe of companies that will engage with SPACs and consider the SPAC has also grown very meaningfully. But there are also many SPACs going after those targets. And so I think it is a natural consequence of competition that, as you know, most of these SPACs are set up with 2-year deadlines. And when those deadlines can close, arguably not every single team will be able to get a transaction completed. But by the way, that is precisely the way this market is supposed to work, right? And as you know, there is an embedded mechanism whereby capital goes back to the investors if a SPAC does get to the end of the deadline. And that is a perfectly fine way to go forward, right? I think a bit more, a bit of a higher bar when it comes to the sponsors and the target companies that will clear the market will only really elevate the quality of the whole ecosystem on a go-forward basis. When you really think about the 2-year deadline and the big spike in volume we had last year and this year, it obviously means that we're probably 12 to 24 months away, right, from really seeing the concentration of those deadlines coming up. And we'll have to see whether the M&A side of the market can really keep up with that. But again, my own expectation would agree with your statement, which is I think we'll see what's been historically a really, really low liquidation rate for SPACs, under 5% over the last 7 years. I think we'll see that go up, which again, I still think points to a healthy market. But again, not everybody should be a winner necessarily.
Well, to Sharon's point, we're involved with both as an issuer, as a promoter here, and secondly, as an investor. And from an investor point of view, I agree with Sharon. It's a wonderful way to get an early look at a company, especially in sectors that you have some expertise or interest in. And you get a chance, some optionality there. You get to look over the shoulder of the promoter in terms of looking at the company, looking at its forward projections. The warrant gives you a real incentive to be involved with teams that can ferret out companies that can really benefit from the new capital that they would have and start to either fulfill against a plan or really accelerate their expansion plans with the onset of this new set of resources that they have. So I think it's attractive from both an issuer and an investor point of view. And last year, Sharon, I don't know if you're seeing this in your portfolio, but a couple of family businesses that we were engaged with, it seemed to me that this would have been a really good solution for them, because Sharon, you mentioned that it gives you a chance as let's say you're a second, third generation family business. Well, third generation, not likely that everybody's involved with the business. Some people have moved away and maybe they're getting dividends. And now you have an opportunity to say, look, do you want to stay in the business? Do you want to take some liquidity now? Do you want to take all of your liquidity? You live in another country. You're not really interested or involved with the business. Sometimes those businesses have been starved for capital because family interests say, no, don't expand the business. We need the resources today. And so we had a couple of families that we were advising, and I thought for them, a SPAC would have been an elegant solution. Good tax treatment, gives them some flexibility in terms of raising capital, making sure they did the things that they need to do to play in the big leagues, which the public markets are, which is in terms of people development, strategy, governance, ESG, all the things that they had to pay attention to that maybe they didn't have to as a private company. So in those two cases, that's what convinced us to cross over and say, we want to be an issuer too, because particularly for family businesses, as Sharon pointed out in her example, it solves for a lot of different problems.
So recently, last year, I spoke with Atlas Merchant Capital's David Seamus, and he mentioned one of the reasons that SPACs are so big right now has to do with PIPEs, or private investment in a public entity. And we have a question in asking can you explain PIPEs? So Carlos, what is a PIPE and what role does that play in SPAC mergers right now?
Happy to. So a PIPE, as you said, Emily, is just effectively a round of equity financing that is done at the time when a sponsor and a target company have already agreed to pursue an acquisition. The PIPE is usually put in place before the public announcement of that transaction. So the goal is to try to line up that round of equity, which comes in on a committed basis, right? It only funds at the closing of the transaction, but the equity capital is committed up front. And so that gives a lot of momentum, and it's an endorsement of the deal when a club of investors effectively are coming in and committing capital into the deal at the valuation, right? So think of it as a round of equity that, from the perspective of both the sponsor team and the target company, has the advantage of being done early before a public announcement, right? So that, again, back to the point on risk mitigation, if you go to the PIPE market to raise incremental equity, and you completely fail, and every investor tells you that the company is overvalued, it gives you a chance to go back to the drawing board and make adjustments or reconsider your options, right? And you haven't exposed the company publicly, and you don't have a failed deal in your hands. And that is a big deal from a risk mitigation point of view. And so if the pipe gives you that validation, when the pipe does come together as expected, right, it's a great validation of the deal. It is committed capital, right? So, it is not at risk of not being there at closing, which I think is, again, from a risk mitigation point of view, quite important. And then most of these pipes, although they don't really have to, but most of them are done as equity at $10 a share, which is always kind of the base share price for most of these SPACs. And so they also provide capital that is comparatively less dilutive than the capital that is coming from the SPAC. And so there is a cost advantage, there is the validation, and there is the certainty that comes from the committed nature of the pipe. And so we are seeing effectively a lot of SPAC transactions come to market with these committed pipes. It's become a very popular way of structuring transactions at the time of business combinations. And again, the pipe.
Carlos, you said it's a second form of a check in company value and pricing. So the first stage is you have a negotiated price between the SPAC sponsor and the company. So I said, here's the overall enterprise value. Here's what the balance sheet will look like after de-SPACing when we're a public company. And now you go to the pipe market to raise additional equity between to cover the gap between the value of the company and the proceeds that would come with the pipe, with the SPAC.
Mm-hmm.
So the pipe fills in that in between and gives the rest of the investor community an additional check that says these very sophisticated investors committed their capital, got in under the hood, verified their point of view about the landscape of the business is in, the business itself, its management, and its valuation.
Exactly right. Exactly right. It's incremental equity capital that may be, again, what the target is looking for. And so it helps you get to that total quantum that you need to provide. And it is the validation and the certainty points that you just made.
And is it correct to assume, Sharon and Carlos, that some companies, some combinations of SPACs and target companies would do a pipe, even if it's not essential to get that second form of validation?
Yes, we see this particularly being often required by the selling company. Because if you think about it, if you're a company looking to go public through a SPAC and you don't consider a pipe, again, you hope that the story will be well received, that investors will be excited and will want to own it. But there is always that risk that is on the flip side of the investor protection through the redemption right. That redemption right is a risk from the company's perspective. And one of the ways you can clearly mitigate against that risk is by introducing a pipe into the equation, right? So
both for validation and for replacement capital?
Correct. Certainty of capital and validation are the two key reasons. And again, every situation, as you know, is bespoke, and it's a question of what are the uses of proceeds. If I end up with no redemptions plus a pipe, do I have a use for all that capital? And as well on the other side, right? If I don't go with a pipe and then I get an unfavorable redemption outcome, what happens then? That is the kind of conversation that takes place.
But truth be told, the pipe markets have been stressed this year because of all this new issuance. And so there's only so much capital bandwidth and human bandwidth to go around. So these pipe buyers, the people who supply capital to pipes, are fatigued and overwhelmed. And they're saying, wait, if we're going to do a deal, we're going to have a much higher bar in terms of threshold. Ergo, I want a better price for my investors. So we've seen a couple of pipeless deals being done recently. No pipe deals. What do you see happening there in the weeks and months ahead? Will that become more in fashion because of the backup in the pipe market?
I think so. And it's interesting, Jim, if you rewind the tape on the SPAC market beyond the last 18 months, pipes were a relatively extraordinary phenomenon in the context of how the SPAC deals have been done for decades, right?
Historically, yeah.
Correct. Historically, the proportion of deals with pipes was a lot smaller, a lot lower. And so we could very well go back there, right? In a sense, if the market depth at the moment in the pipe market is limited, and it is, and I agree completely with that view, and it means that then the pipe investors, those who are selectively deploying capital into pipes, are requiring a steep illiquidity discount in order to fund deals. I think there will be many teams, again, when the circumstances of the target company and its capital needs allow for this, right? They may very well decide to go without a pipe. And quite frankly, just do the marketing of the story post public announcement, which still gives investors, long-term investors, an opportunity to come in by buying shares of the SPAC, obviously between announcement and closing.
I see.
And you can rotate the shareholder base if necessary and market in order to minimize redemptions. And that is a perfectly fine way to execute the deal as well, right? So if the pipe market remains overly challenging, unreasonably challenging, I would expect more teams to go down a pipeless approach until that market heals itself a little bit.
So give us a little color on that, Sharon and Carlos, if you would. Emily, when the third check is you're actually going public, and your original SPAC investors for their $10 per share got a share and a % of a warrant, some warrant coverage. And now they get to say, okay, I see the deal you want to do. I've been exposed to the management. I've seen your reporting. I've interacted with you and the management team, seen their business plan. And I either say, yay, I'm staying in, or nay, I want to sell my interest. And that's what you're talking about in terms of redemption, Sharon and Carlos? That's
right. Exactly right. There is, at the time of that shareholder vote.
So your third check.
Exactly. That is the third check. So again, I
think
said
historically we're looking at 5% redemptions. I assume that's up now. Is it?
5% liquidation rates, Jim. So that statistic was really the percentage of all SPACs that ended up returning the money entirely to investors, not having completed a deal.
I got it.
So a little bit different, right? That's when the 2 years are up. If they haven't found a deal, the money goes back to shareholders.
So what was the historical redemption rate and what is it today?
So that is something that has been, quite frankly, ebbing and flowing a bit more over time. You do see the kind of the variability in that statistic as a function of kind of what equity market conditions look like over time in the broader equity market. So periods like, the end of 2019 or going back to 2015, 2017 as examples, right? There've been time periods where redemptions have been a bit more elevated. When you look at the experience over the last 15 months, of course, we've been on a fairly bullish, broader equity market, right? The tone has been quite strong across the board. And so redemption experience on average has been quite limited, fairly minimal. There's always exceptions and there's always specific deal circumstances, either a company that is truly in a sector that's out of favor, or maybe a good company in a good sector that is simply very richly valued, where the market just doesn't see much upside in owning the stock at that valuation, right? That can be another reason behind the high redemption rate. So I think the average for this year to date on all the M&A deals completed is inside of 10%. But just like we talked about before, the go forward, I think, is a bit of an open question on redemptions, right? I think the going is going to get a little harder for deals that are either in progress today or soon to be announced. So we'll have to see. It'll be all a function of whether those deals sort of adjust to the new market expectations from a valuation perspective and are still able to clear. But those that do not may actually see a higher percentage of redemptions when they get to closing.
I see.
And, from our point of view, sometimes it definitely depends on the nature of the investor and why they went in. Now with SPACs, it was hard to find a SPAC trading at 10 or below during the first quarter. But now that people are picking SPACs up at like $9.75, and they're using it, as I said, the cash management alternative. They can redeem it at 10 for a 3% return, and then hold on to the warrant. So, or if it's a merger, arb investor, depending what their objectives are. So for us, it depends on why our clients went into it in the first place.
How much of the, either of you, how much of the fact that there's a good number of SPACs trading below 10 is a function of the move in the interest rates?
I think it was definitely one of the components. Obviously, anytime interest rates go up, growth companies, there's opportunity cost being in growth companies, especially where the returns are farther out. So I think that was part of it. I think just the sheer volume from what went on at the first quarter being more issuance than all of last year. I think it was 92 billion or something in the first quarter. If you annualize that to, there'd be 1,100 deals for the year with 350 billion. Correct me if I'm wrong, Carlos. I don't think there are enough private companies to satisfy that. So I think, people lost interest in SPACs, and they, in large part, the retail investor dried up. They were buying a lot of it. And then finally, regulatory risk is always on people's minds. So I think those are the reasons that so many of them are trading below 10.
Yeah, well, if your underlying security is in treasuries and the yields go up, so the value of those treasuries come down, that has to have an impact. What impact does that $138 billion of committed capital raised in that first quarter? It's all sitting in places, let's call it UBS.
Hopefully.
At all. What impact does all that capital raised have on the capital markets, Carlos?
I feel it's obviously a significant amount, but I think in the context of the broad capital markets, again, it's perhaps transitional liquidity, right? It's effectively parked in treasuries, but that it's going to flow back into the aggregate market cap or the aggregate equity capital markets, hopefully at some point down the road. As you know, that it is purely U.S. treasuries with nothing fancy about it in the way these trust accounts are invested by design, right? That is meant to be extremely safe deployment of capital on behalf of investors at the expense of obviously interest income these days with the rate environment. But it is the way the structure is really meant to work. That was one of the key changes that drove some of the first waves in the SPAC market, where early on in the ancient history of the market, there were real concerns as to the safety of that capital while it was sitting in a trust account, and people were skeptical that the risk was obviously that a sketchy sponsor could take that money and run. So one of the ways in which this market started to take meaningful.
That would give Emily something more to write about.
Exactly. It may make for a more interesting movie script, but so at some point in time, these trust agreements became quite ironclad and quite restrictive. And again, that money is meant to really be sitting there with safety and no risk really taken in the deployment of it while it waits for the outcome.
So we go back to the original three ways that companies, and Sharon, to your point earlier, I think there are plenty of companies that are eligible to, I think there are more than 5,000 companies just in US private equity portfolios, or maybe quite a bit more than that. So I think there's enough companies. I think, do you have enough banking capacity, investment banking capacity? Do you have enough time for these to be properly, judicially looking through the marketplace to find the right companies at the right point in time, marrying them to the right capital, the right team, the right capabilities? So I think that's going to cause the splashing around. I think there's plenty of opportunity. What, Sharon or Carlos, I think there are half as many public companies today as there were 20 years ago.
Exactly. And I think that is one of the key reasons why I think the whole SPAC ecosystem has developed so much as well, right? This is a way to reverse that trend a little bit and really provide public investors with opportunities to get exposure to a lot of stories that have been growing and developing in the private markets. And the SPACs are bringing those to the public light and allowing public investors, retail and institutional, the chance to participate. And another reason that I'm bullish longer term is, if you think about it, yes, obviously there is arguably an ecosystem of sponsors that are motivated to transact, and that can point to maybe a higher risk that a suboptimal deal is executed. But also, and back to the point about the quality of the sponsorship, the investors in a SPAC in a way benefit from the fact that the likes of you and your team have actually kicked the tires, and they've done the due diligence, and they've applied a layer of diligence, assessment, oversight, and ask the questions, right? When you bring something to market, it's coming with your stamp of approval. And I think
our capital at risk.
And your capital at risk, exactly. So the alignment of interest from that perspective. And so I think that is another advantage that, as an investor, you are effectively investing with Jim and his team or others of high quality as well. And I think, again, there will be room and a need for that, and an appetite for those opportunities, I think, going forward.
Emily, when we reconvene a year from now, I wonder, when we look back at this year we're about to go through, how this will have worked out.
Yeah, it's a great question. And speaking of, we have quite a few questions in from the audience that I'd love to get to before we have to wrap up. So first question, what are the advantages, disadvantages of a direct listing versus a SPAC? I feel like there's been a lot of talk about IPOs versus SPACs, but what are the advantages and disadvantages of a direct listing versus a SPAC?
I'm happy to take a quick crack at that. So with a direct listing, you're not really working proactively to generate demand for those shares that will be listed. And so you miss, in a way, the opportunity to educate the market about that story and generate interest that may lead to good performance in the aftermarket. Against that, there may be a cost argument, for direct listings, right? People may look at it and feel that because you're bypassing the traditional IPO or the SPAC process, that perhaps the cost of getting to that outcome are lower. And so again, different companies will weigh the pros and the cons and make decisions, but I see those as the two key differences.
Amazing, thank you. Is it possible from a regulatory or financial standpoint to use a SPAC with the main underlying assets / business located abroad?
Yep, not only possible, but a growing trend in the market. We were involved with a SPAC called Altimeter that is buying a company called Grab, which is effectively an Uber-like company in Southeast Asia, very high growing, $30+ billion enterprise value. So increasingly teams are looking to connect the liquidity of the US capital markets through US listed SPACs with targets that are interesting, high growing and exciting in other jurisdictions. And one of the cornerstones of the SPAC is the flexibility. Jim talked about the ability to tailor cash versus shares and really solve efficiently for the needs of a seller. But I think there is also flexibility with respect to the targets that can be in scope. And, effectively, they truly are a blank check in that, anything is possible with the SPAC, so long as investors will approve and obviously, and it passes muster, but very flexible.
I never heard the word bespoke used so much until we got involved here.
Another question from the audience. Is there a minimum size for SPACs to be created?
When thinking about size, we always keep in mind the need for the SPACs to be reasonably liquid and to have enough of a capital base to attract kind of real companies on the other end, right? So there certainly have been SPACs raising under 100 million, but usually where you tend to see bigger banks get involved, the likes of UBS and others, tends to be 150 and up in terms of minimum size. But again, that isn't technically a requirement. There have been SPACs in the history of the market as small as 25 and 30 million, to give you examples.
One SPAC factor that people have noted is that because the SPAC is already public, there's no mandated quiet period in discussing the acquisition. Do you expect the SEC to close that loophole?
It is unclear to me who is negatively affected by that dynamic. So I don't know, when I think about the SEC's role, obviously they're there to ensure transparency, appropriate disclosure in the marketplace that allows all investors to make well-informed investment decisions, right? And when you think about it from that perspective, I think there may be changes driven by the increased regulatory scrutiny that go along those lines of actually maybe pushing the market to take steps further in further enhancing the disclosure that is provided to the market, which I would argue is relatively robust already from my perspective. But again, this is effectively a merger by a public company that right now follows the same set of rules that applies to any other M&A situation with any other public company, right? So nothing, you know, again, the SPACs are a little bit different, but they don't require a whole rethink of the regulatory foundation beneath them. So I'm not really sure that the SEC will feel the need to go there, because I'm not really sure what issue they would be fixing with that necessarily.
Jim, I have a comment / question for you from Thiago. As an investor, I tend to see SPAC as the possibility of choosing administrators and partners instead of choosing companies to invest in. On the other hand, I can only imagine how the management team feels by being under this pressure. I mean, the responsibility of being chosen. He'd like to ask you, Jim, if you feel a different responsibility being part of a SPAC as opposed to being part of a well-established company such as the 1-800-Flowers.
Yeah, I think that's a good insight. I think it's quite a bit different. When we have our SPAC hat on, we're looking for companies. You're looking at the obvious things that Carlos and Sharon have talked about. You're looking for the industry that they're in, their position. You're looking at the management team, their ability to execute, the capital requirements. But as much as anything else, you're looking at, is this team open and flexible? What's their culture like? Will they be able to really benefit from this injection of capital? Will they be able to benefit from the new opportunities that creates? What is the impact of COVID been on their industry? So there are so many other things you look at now. So it's funny to have been for 40 plus years telling other people the story of flowers, and now to be in the other seat looking. It's funny how the lens in your glasses changes your perspective, and how important the chemistry of the team, the culture of the organization, and how we as a team would be able to interact and hopefully benefit the company with our input. But don't forget that we're not going to own a majority of the shares. We're going to have just a seat at the table. So you're judging how receptive they be to the outside voice.
That makes a lot of sense. Sharon, when you speak to your clients about this, what sense do you get from them in terms of like the responsibility that they feel?
The responsibility that the clients who are, for example, that are PIPE investors or clients buying on the IPO, I would say it's different. I would say our clients who are PIPE investors, and many of them are brand name investors to that validation point, they feel a responsibility to get the best deal. And something we've heard recently from them is how the pendulum has been swinging in their favor in terms of not take or leave this PIPE, but they can really get involved and drive better economics for their team. And the regular public market investors, it depends. Their responsibilities are to themselves and their families. So depending on their objectives.
That makes sense. Another question from an attendee: will SPACs still make sense if the seller has to pay the proposed 39.6% tax plus a state tax of approximately 9%?
I'll let Carlos take that.
So that always kind of depends on the form of consideration. But again, back to the point about flexibility, a lot of the way that SPACs are able to transact with companies that are meaningfully larger is by issuing their own shares in the context of a business combination transaction. And in those cases, when the seller is getting shares, that is not necessarily a taxable event immediately, right? They can then hold on to those shares, and obviously the tax would kick in when they ultimately sell those shares down the road. So again, the SPAC can be a way to position the business in the public market, get that access to liquidity, and it can be done certainly in a fairly tax efficient manner, higher rates notwithstanding.
Yeah, and that's where really good financial planning and estate planning techniques come into play on how they're structured before the sale. The pre-planning is so important.
Well, guys, this has been an absolutely fabulous conversation, and I wish we could continue it, but we are going to have to start wrapping up. But before we do, I want to ask one final question of everyone. I know we've talked a lot about the pendulum swinging, and obviously, it's expected to start swinging back the other way. But I'd love to kind of hear what you guys think, especially Carlos, as you've been in this for a while now. Like, what do you see 5 years down the road? What is the SPAC market going to look like then, 5-10 years from now? Do you expect it to maintain this like high level, or do you think the pendulum's going to swing even further away?
I would agree with the way Jim framed it at the beginning by saying that the SPAC will be just another established way to take a business public. And so I do expect that it will remain a relatively large market. I don't really know if there will be another really, really meaningful leg up that would necessitate another meaningful expansion of the investor base. And it may happen, right? It may happen when you think about the amount of total capital in the SPAC market compared, for example, to the total AUM of the private equity or the venture capital industries, right? There is certainly room for further growth. I would imagine that the market continues to get more and more professionalized and institutionalized, because if you think about it, in a competitive environment where all these SPACs are running around with the same kind of dollars in their trust accounts, it goes back to that value add and that ability to bring something beyond the capital that I think will drive who the sponsor winners and losers are over time, right? So I would imagine that we end up seeing higher quality, more professionalized sponsors who do this on a repeat basis. And that kind of becomes the market. And again, the new entrants, the first timers, the one-offs will have a tougher time breaking in. But that again should lead to better executions on the back ends and a healthy long-term functioning market. So I do think it's here to stay. We're obviously highly committed to it at UBS, and we were doing our part to try to bring a dose of discipline and expertise into all aspects of it. But we're quite bullish about the long-term prospects for it.
Jim, you ready for your next SPAC after this one?
I would expect, it's our intention to do a series of these. We're not in a hurry to do it, but do a series of these, because what we're trying to do is build a portfolio both in the private space and in the public space via SPACs of companies with a common set of needs that we have built a core of expertise that could help each of those companies. So if it's in a private space, which we've been doing, fine. If we find a few companies that are appropriate to do a SPAC with that have a common set of needs like those that we can help, that would make for a nice portfolio over the next 3 to 5 years.
Sharon, what is some bright spots you see in the horizon?
Well, I say one bright spot in the SPAC market is all these new companies are giving an opportunity to qualified candidates who happen to be women or diverse candidates to serve on boards. And I think that's a real inflection opportunity. And I hope these companies are looking to diversity and qualified candidates. And in terms of our clients, I think this shakeout, if you will, that we're going through now is going to give us opportunities to pick up, as we say, babies that have been thrown out with the bathwater that, could be very good opportunities. But also, going forward, I look forward to having our clients diversified and, within companies with the right valuations. So I think SPACs are great opportunities for clients to get
And
more
on top
exposure
of
to
a
growth
roaring
companies.
economy that's beginning to really roar here, you're going to have $125+ billion of new capital into newly minted public companies that are looking to spend that money on growth.
Is an exciting time. This has been such a wonderful and fascinating conversation. I want to thank Carlos, Sharon, Jim, thank you all for speaking and giving such wonderful insights. I feel like I've learned a ton, lots of great editorial content to come out of this conversation.
Took a lot of notes, Emily.
You did a great job, Emily. Thank you.
Thank you all for speaking. Thanks for everyone who has attended. We really appreciate you guys coming. And I believe, Josh, correct me if I'm wrong, we have a